Hi, this is Brian from KineticTrader.com. We're going to do a quick summary here on using weekly options with covered call strategy. So covered calls is a popular strategy with option income investors. If you own the underlying stock, say example you owned Amazon and you wanted to generate some income or like a dividend type of equivalent premium, then you could sell a call option against it. And with weeklies, this allows you now to sell call option every week versus a monthly. It was once a month. And the benefit is that with weeklies, with the short time to expiration, you're generating a lot more time value quicker on it versus a monthly where you'd have to wait till the last week or two of expiration to really collect that decay in time value. Generally though, from what I've read and seen, is that just because you're writing weeklies every week does not mean you get 4 times or 4 weeks worth of premium versus one monthly. It generally works out to maybe you get about 2 times in monthly premium what you get just writing monthlies once a month. But you always have to just, of course, pay attention where volatility is at, because volatility can have big swings in the time value of an underlying option. So with covered calls, the big thing that people pay attention to for weeklies is since you're really collecting that rapid time decay, you're focused on extrinsic versus intrinsic value of the option. So if you're looking here, for example, on Amazon, with that 204.38 is the current market price after the close here. If you sold at 205, which is out of the money, then you're collecting all time decay on that, so it's $1.46 or say roughly $1.50 here in extrinsic or time value on that option. If you sold an slightly in the money option, say a 200 strike, so it's $4.38 in the money, well, even though these numbers are a little skewed because it's aftermarket with strange bids and spreads, you're getting 85 cents in time value and 405 in intrinsic. So your potential, if the stock's closed here at these levels, the time value priced into that option you sold is 85 cents that you collect, or $85 on one contract and 100 shares for that week. So people generally, if they're positive stock and want to just keep writing weeklies against their position, they can look at the range that it's been trading at, and if they're bullish that week and think it's going to move higher, they can sell an out of the money option to collect some upside potential on the underlying stock while also collecting some time value on the out of the money option, call option. Or if they're slightly cautious that week, if the stock's made a big move and think they'll pull back, they could collect less time value and by selling a slightly in the money option, for example like the 200. So if the stock pulls back a little by Friday's close, say down to 202, well, at least that $2 and change pullback, they'll also see that decrease in the value of the option that they sold. So they're going to collect some of that premium that they sold that was tied into the underlying price. So hopefully that makes sense, but it's just something to pay attention to. And really with weekly options, if it's always being expiration week, you're just paying attention to the time value, intrinsic value, and looking at where the stock is at and what your profit and protection is. Finally, the last popular strategy that people like to implement with covered calls is doing a collar trade. A collar is where you're buying a protective put on a position. So if you're bullish Amazon or you owned it for a while and you want to protect the downside of your profits on it, you could buy a put that's maybe slightly out of the money as some protection at a farther out expiration month. So example, I just randomly typed up say a 200 put and it's a couple months out and say you're willing to let the stock pull back a little by that time, but you want to protect potentially if there's some catastrophic drop or whatever on the stock. Well, you'd be protecting from 200 down on this with the put, but at $7.80 you want to pay down some of that premium. What you could do is sell out of the money calls every week. So say you could sell a 205 call here. Again, there's only a couple days left, but you could collect $1.50 in premium, and if the stock closed below 205 by Friday, you get to keep all that premium, and then you can use that $1.50 premium to offset some of the costs of the put. The important thing though is on the protected put, you want to buy farther out so that you're not experiencing much time decay on the put. Otherwise it's kind of worthless selling calls and collecting time decay on calls, and that you're also seeing time decay on the put. So you do have to pay attention what volatility is priced into the put that you're buying at a farther out month relative to kind of what the time premium you're getting on those calls. But that is a popular strategy, and you definitely with weeklies can more times than not pay off the cost